Okay, welcome everyone. It's my great pleasure to introduce this panel on how can macroprudential policy mitigate climate-related systemic risk. And I'm Jeremy Zettelmeier. I'm the director of Bruegel. This is co-organized with the National Bank of Slovakia and Bruegel. I'm extremely pleased to be here in Bratislava and be doing this event with the National Bank. The National Bank is a fantastic institution. It has great thinkers in it, independent people, to the point that, as we know, it gets called upon to essentially supply the entire government in times of need for Slovakia, and then, of course, leaves, as it's supposed to do so, when a proper government is elected democratically. So, very pleased to be here. This is a very important topic, even though it sounds dry, right? So for those that are not completely familiar with the context, macroprudential policy is essentially the type of, I would say, public sector influence on the financial system, and particularly on banks, that central banks are directly responsible for, as opposed to financial supervisors who deal more with microprudential policy, which is policy supervision and regulation of individual bank risks. So these are essentially the big rules. We have such rules, for example, to deal with macroeconomic risks resulting from credit booms. So typically macroprudential tools try to mitigate overlending. They also try to affect the structure of lending, to limit, for example, foreign currency borrowing in the mortgage sector, which was one of the key problems that led to and propagated the Eurozone debt crisis, specifically here in Central and Eastern Europe. And now the question is whether we should use these tools to deal with climate-related financial risks. And of course, the view is that these types of risks could be quite severe because climate change is having a pretty severe impact, even in the short term. As we know, 2023 is the hottest year on record, I think, since certainly in the last century, maybe since the beginning of measurement. We had many climate-related catastrophes in the summer before that, in the summer of 2022. And we have policy reactions to these physical risks that can themselves generate risks, something that's referred to as transition risk. And so central banks who have financial stability as one of their mandates, in the Euro system, it is not the primary mandate, but it is one of the secondary mandates, arguably the most important one that is universally recognized. Central banks are worried. And so central banks have started thinking about it and are doing something about it. And this has led, after many years of work, to a really big, important report published by the Eurosystem of Central Banks in connection with the European Systemic Risk Board last December, which probably will have a big impact. And so with me to discuss these issues are Rainer Martin, who is Executive Director here at the National Bank of Slovakia. He was also at least loosely involved with the preparation of this big report that I just referred to, and he will talk about that. We then have one representative of a Eurosystem National Central Bank, Kristina Boyari, who is the chief economist of Latvia's Banka, who will talk about essentially macroprudential policy in this area in Latvia and how she thinks about it, why it is important. Then, very importantly, we have Adam Banai, who is Executive Director for Monetary Policy Instruments, Financial Stability, and Foreign Reserve Management at the Magyar Nemzeti Bank, at the Hungarian Central Bank. You wonder what is left for the other executive directors, since he has such a big portfolio. And, the Hungarian perspective is very important For two reasons. First of all, it is, of course, not yet a member of the Eurosystem. It has its own monetary policy, its own macroprudential policy, but also, and unusually, it has environmental objects as an explicit secondary objective of policy. So it actually has two reasons, not just one, or maybe three reasons to think about climate change, its impact on inflation, its impact on financial stability, but also its direct impact. And finally, with us online is Silvia Merler, who is a non-resident fellow of Bruegel and also chief economist of Algebris, an Italian investment bank. And her specialty is climate finance. She's an authority on climate finance. She thinks a lot about climate finance in capital market context, but she has also been thinking about macroprudential policy. So the way we're going to organize this panel is we will have opening presentations of about 6-7 minutes. Then I may have two follow-ups with the panelists, probably two rounds of questions, and then we will throw it open to the floor. You can ask questions in two ways. For those that are in the room, just raise your hand. And for those that are online, or if you prefer, if you are in the room, you can also use this. You can ask questions on Slido, Slido, which is an app, which is very easy to use. It's you can use it on your mobile phone, and the hashtag, the Slido identifier, the code that you need to use so that the questions get displayed on the screen here in front of you is hashtag green policy in one word. Hashtag. I think it's over there. Good, and then I will take some of these questions. So without further ado, let me hand over to Rainer.
Okay, thank you very much, Jeromin, and a warm welcome to everybody here in the room and also online on behalf of Národná banka Slovenska. It's a great pleasure for us to host this event here today. So let me go straight into the topic, and let me start with a few words of introduction. So green macroprudential policy, this is definitely a very recent dimension of macroprudential policy, but this in itself is a relatively new policy area. So it's a new version of something that's also new. And that, of course, means that there's quite an exploratory feature to all of this here. Now, what is the overall aim of macroprudential policy? And that applies, of course, also to green macroprudential policy. Well, it's to contribute to maintaining the stability of the financial system as a whole. So unlike microprudential policy, which is on specific financial institutions. And to make this a little more operational, there are two big sub-objectives of macroprudential policy. The first one is the strengthening of the resilience of the financial system. So that usually implies build-up of capital buffers. And the second one is the reduction of systemic risk. So this is about risky housing loans, for example. This is something that is quite typical. In this case, of course, we're talking about climate risk, but the basic rationale is still the same. And I should also say, because Jeromin was referring to the mandate, the work that has been done here is very much grounded in the financial stability mandate of the ECB. So what I'm going to say in the next couple of minutes is basically an excerpt of the recent ECB ESRB report on with a nice title, Towards Macroprudential Frameworks for Managing Climate Risk. And that brings a lot of thinking over the last couple of years to a sort of culmination. This is a pretty voluminous report, and it has three main aspects. So the first one is that it talks about a surveillance framework for financial stability risks and climate change. I will be very, very brief on this. The second, I will be a little bit longer, is on policy considerations for banks and also non-banks, but I'll skip the non-bank part because, again, otherwise this would be too inclusive. And it also covers nature-related risks and what they mean for financial stability. So, for example, the loss of biodiversity. But this is, again, off topic for this particular event here. And I will close with a very brief exposition of an experience, the first experience that we have made in the Slovak Republic with green macroprudential policy tool. So on the surveillance framework, as I said, I will largely skip this. I just want to say that the report argues that the list of relevant indicators for macroprudential policy has been growing. So if you speak to practitioners, of course, they say we would need still a lot more. And I have no doubt that this is true, but there was a lot of progress that was made. There is also the argument that bank lending is tilted disproportionately towards firms and households with a high climate risk exposure. That's just a stylized fact. That the distribution of this exposure is very different across the banks. And the report argues rather convincingly for to use stress testing and scenario analysis as a way forward. But let me now move to the macroprudential policy framework and talk about this in a little bit more detail. So one of the main arguments in the report is to say that the macroprudential policy framework for climate should be gradual and targeted. Now, why is that? What is the reason behind that? Well, first of all, in the case of climate change, there's a very strong argument to say, well, we should weigh the cost of early action based on imperfect information against the cost or the risk of acting too late. And I think this is very important in this field because we still do not know enough about climate change. We know more and more, but still not enough. So it's not really an option to wait until we know everything about it, because there is a certain urgency, of course, that we see in this field. But what is the consequence of this? Well, the consequence is that, as argued in the report, macroprudential policy should be applied progressively over time. So you start with something probably relatively modest at the beginning, and then you develop it further as more information becomes available and as the remaining uncertainties about the timing and the nature of both transition and physical risks decrease. And an important aspect here is that this gradual approach, starting with relatively small steps and then building them up over time, helps limiting a very important negative side effect that macroprudential or green macroprudential policy is likely to have. And this negative side effect is that this sort of prudential policy tends to reduce lending. This is a side effect, but it's also to some extent intentional. Right? It's part of the prudential policy, and this is a bit of an issue when it comes to climate and transition topic, because you need a lot of lending to support transition. So having now a policy in place or policies in place that unduly reduce the overall amount of lending can be actually counterproductive. Let me now turn to measures, because macroprudential policy has two main groups of measures. So one is the capital-based measures and the other one are the borrower-based measures. Starting with the capital-based measures, so these are additional capital requirements for the banks. So the report argues that to reduce the systemic risks arising from climate change, a targeted use of macroprudential capital tools should be used in order to address the vulnerabilities that are currently in the portfolios, in the assets of the banks. Now, this sounds fine in general. Of course, if you want to put it into practice, what is needed here is a lot of data. So you need to have quite granular definitions of the risk exposures. And what comes on top is that you need to have also an idea about the trajectory of these exposures going forward. So you need to account of these transition trajectories. And if you know how these works, there's sometimes decades into the future. So it's really, we're talking about the long term here. But knowing more about this enhances the efficiency of capital buffers and would limit, again, I come back to the side effects on financing and lending. Now, there is one concrete macroprudential policy measure that is discussed quite prominently in the report, and this is the systemic risk buffer. A systemic risk buffer is available for use. It's an existing tool in the macroprudential toolkit, and it's deemed flexible enough to fit a range of design options depending on the scope and the choice of exposures. And I'll get back to this in a minute. There's also a discussion about possible amendments to other capital-based measures. So, for example, the idea of a sectoral systemic risk buffer, but this is more a secondary objective. So most of the discussion is prominently about the systemic risk buffer. So let me just illustrate this point briefly with a chart here. On the left-hand side, you have a stylized presentation of key systemic risk buffer design options. And the argument here is to say, well, it depends how granular you want to be, and it depends how much you want to bring into the scope. So you can, at the extreme case, you can have a single rate for all the banks and all the that you cover. This would be on the top right-hand side. This is the general systemic risk buffer. You can also have multiple rates depending on the exposure. And you can exclude certain exposure, and then that takes you more to the left and further down in this chart. This is just stylized. There is no calibration here. But when you turn to the right-hand side, this is about the impact of a climate systemic risk buffer on credit growth. And the colleagues in the ECB the drafters of this report, they made the effort to try and simulate what the impact on lending could be. And depending, of course, on the methodology you use and the existing studies that you use to multiply this, you come to a range of potential negative lending effects. They range more or less from pretty much nothing at all, which is probably not realistic, to something like 6% per year as a decline. So again, this all depends on how you calibrate the systemic risk buffer, how granular you make it, and what you are all bringing into the scope or not. So that's on capital-based instruments. Let me now turn to the borrower-based measures. So borrower-based measures are, for example, restricting the loan-to-value ratio or the DSTI requirements for loans, and they've proven to be a very efficient, very effective macroprudential tool on other topics when it comes to risk from real estate, for example. So for the climate issue, it's argued that as data gaps are gradually closing, borrower-based measures may also be used to complement the capital-based measures in addressing some of the borrower exposures to transition. Now, one disadvantage of borrower-based measures is they typically or exclusively apply to new loans, so it does take some time for them to have a material effect. But then for the new loans, they tend to have quite a strong effect. So it's not a surprise that these borrower-based measures are also discussed and positively assessed as a possible option in the report. Now, when it comes to borrower-based measures, it's not just all about tightening. There is also the option of loosening requirements in order to support green transition. And this is something that I will discuss in a minute, because we have some experience of this in Slovakia and also in other countries. So my fellow panelists will also talk about this. Okay, I'll wrap up very quickly. So this is just a more detailed exposition of how transition risk and physical risks, so climate risks, can affect the probability of default and the loss given default for borrowers. So this is an argument why borrower-based measures can be usefully applied. And then very briefly, this is my last slide. This is about the easing of requirements for green loans in Slovakia, so something that was concretely put into practice. The objective of that measure is to support the transition to a green economy by supporting the renovation of housing. So to make the housing stock more efficient. So there was some easing of the regulatory limits when it comes to maturity limits and when it comes to the maximum installment implied in the DSTI. So basically, makes it possible to have a larger loan with the same income and to pay this back over a longer period of time. The relaxation is conditional on an existing agreement with a state agency. So state support, actually European Union support in this case, is crucial to make that work. But I think it's a useful example of how not just sticks, but also a carrot can be used by macroprudential policy tools in order to support the transition. And the main principles are strict risk neutrality, and basically the idea is to have a concrete measure of the benefits of the renovation. And I'll stop here. Thank you very much.
Thank you. Indeed, this is an important point. So if you want to introduce these green risk considerations, but you're starting from a baseline macroprudential regulation system, there's no presumption that at the end the system as a whole is going to be more restrictive in the sense of making lending more expensive, because you can also reduce the stringency of the existing system. So now we have Christina, who will take us through a specific national central bank perspective.
Thank you, Jerome. Of course, my name is Kristīne Bojāre. I'm an economist from the Central Bank of Latvia. And I guess why I'm here is that I am heavily involved in macroprudential politics and directly regarding calibration and implementation of macroprudential toolkits. And what I would like to talk about, given time constraints, is about sustainability in Latvia's banka. And I will maybe give a brief information regarding what we do within our institution, like an overarching look. And regarding sustainability in Latvia's banka, it's not just within our direct functions per se, but it is within our strategy. It is much broader. We are looking at sustainability within our daily activities and functions. And I would say even that we are taking a step further because, for example, if we are looking at areas of focus that we are doing within our analysis, you would say what the central bank has to do with agriculture. But then again, I would like to remind you that sustainability is broad concept, and so things that are happening within these sectors are directly affecting financial system. For example, these sectors are having loans from the banks or using insurance. So we cannot analyze just particularly one institution or only financial system. We have to look at the broader economy. And it is no secret that sustainability is very important and is growing importance maybe at different levels between, for example, European Union also as well within different setup of each member state. But I think in Latvia we have moved maybe a step forward, and we are heavily analyzing and doing a lot of work. Many of my colleagues are involved in these aspects in day-to-day activities. Another thing I would like to outline is that we have internal groups, committees that are specifically focusing on the sustainability aspects. For example, what we can do with each of these sectors, what advice we can give to respective ministries, what we can do ourselves as an institution to be more sustainable, and how to achieve these very important international goals such as European Green Deal and Paris Agreement. And maybe I can move to the topic of the day, which is macroprudential toolkit. And what we have done with this aspect is that actually we have tailored our borrower-based measures. We have implemented, I would say, the green factor, but the green factor is only as in the sense of that we are trying to make some structural shift within our lending situation that we are currently in. And rationale behind this is that housing stock in Latvia is quoting overall old. Only like 50% of all buildings have a decent energo efficiency certification level. And this means that these houses require less, for example, expenses on the heating, which is very important. Why is it important in Latvia? Because not only this housing stock is old, but also we predominantly rely on the gas. And as we have experienced, there can be many rapid changes within the price of this resource. And also we know that going forward within EU, there will be some taxation or expectations regarding this kind of resource. So it is expected that this either countries can reform themselves, or this resource will probably be more expensive as the years go by. And what we see in Latvia, I think what we see in many countries, that the typical consumer chooses cheaper housing with the expectations that this person can have. And of course, cheaper means, in Latvia, it means older, not renovated, with some problems. And usually, for example, one of these aspects is that these kind of houses require a lot of heating, and consumers have to pay a lot of money for this basic utility. And we kind of looked at the risks on this. And one thing that we, for example, were experiencing last year was this rapid price of gas, and it affected directly our households. And it is, since we are looking at the future, we know that we have to look at, for example, this collateral and solvency risks of these persons, that they will have to pay more and more on this. And when we are comparing to these renovated or new houses, of course, they have less energy demand and they are more efficient. And what we want to do, we would like to make this structural change. And way forward on this is would be nice to have structural shift. Of course, we acknowledge that macroprudential policy is not don't have the predominant role in this. Of course, central government and ministries should have more to say in these measures and aspects, but we, of course, can do something regarding macroprudential policy. And when we assessed our options, we acknowledge that, of course, currently in the, for example, EU level, there is outlined that predominantly systemic risk buffer would be more applicable, or something of the borrower-based measures could be done in this. And while we had the debate regarding systemic risk buffer, and there is always a discussion what kind of risk you want to cover with this buffer, and then there would be more deeper debate on this, we focused on the borrower-based measures. And we focused on this saved costs approach. For example, in very simple case, we look at this person who is paying high amount of money with its utilities regarding heating, versus the same type of apartment this person would have to pay if this apartment is in energy efficient housing. And we kind of quantified that, and we came to the solution that we can do something about the current borrower-based measure framework. And what we did, we basically tackled two instruments. We took and relieved the current debt service to income. In short, that is the amount the debt person is servicing its debt versus its monthly income. And we alleviated it from 40% to 45%. And how we did it, we quantified the basic benefit this person would pay in utilities regarding heating in non-renovated versus renovated apartment. And you can generate average saved costs for this person for this type of standard apartments. And then we saw that the space that could be relieved is around this additional 5 percentage point. And one could argue, is that the right thing to do? Maybe it wasn't the good thing to do, but if we are looking at the sense that this person will anyway pay this kind of amount either to this bill, this service provider, or this person can pay this money to the bank to buy this energy efficient apartment, and in some time when the loan will be serviced and repaid, this apartment will go to this person permanently. And if we look at the debt to income ratio in Latvia, it means all debt that person is having versus the annual income of this person. And we currently had a ratio of 6, and we raised it to the ratio of 8 because it should be proportional to the DSTI measure. We tried to calibrate it when we looked at the financial cycle, and financial cycle is generally very long. It's not like a business cycle, and we want these measures to be structural and even within the financial cycle. And we calculated very prudently, taking into account the changes of interest rate that very directly affecting these loans, and we came up to the situation that we could alleviate it up to 8. So because in some situation, if we increase DSTI, then in situation when the interest rates drop, we cannot maximize this potential because DTI is 6. So therefore, it has to be raised to 8. So it would proportionally could work in both ways. And also, I would also very importantly would like to outline these energy efficiency certificates that you see on the slide here. Why? Because, of course, we in the central bank, we are not scientists of climate. And I think every economist itself is not a clear scientist. Therefore, we have to have some reliable measure or indicator how we can sort out what is efficient, what is renovated, what is good, and what is not. And in this, we use this energy efficiency certification system that has strict conditions, how these houses are evaluated. And when we are looking at these grades, it's ranging from A+ to I think using G, with F or G, and we took from A+ to C as these levels that could qualify for these alleviated measures. Why from A+ to C? Because A+ and A is a typical grade that can be assigned to a new housing, for example, newly built. It's yes, and B to C is something that can be achieved with a total renovation of these old apartments, this problem that we are having in Latvia. So we do not want to only promote new housing and hoping for industry to just build new houses. Of course, we want to renovate the things that we already have. So that would be maybe short summary of us.
Superb. Thank you for making it really concrete, Kristina. Adam, go ahead, please.
Thank you very much. I just put together a bunch of slides which are more like some notes for this topic. So it's not a coherent presentation, but probably you will see useful information. And if it's possible to share, and anybody want to get it, it's free to share. So what is I think a main question as a first step is how we think about the role of a central bank regarding climate change and environmental sustainability. Because as I see in the last years, it became a common knowledge that central banks has some role in this field, but the size of the role is very different from central bank to central bank. It starts from just monitoring and understanding the risk stemming from it, and it goes until we as a central bank can shape our environment and can make significant change in the climate change area. And the Central Bank of Hungary is a little bit special in the sense that for us it is not only a mandate via price stability and financial stability to have to deal with environmental sustainability, but it's a clear mandate according to the Central Bank Act that if we reach our first two mandates, price stability and financial stability, we have to focus on environments that are sustainability. So we have to be active, and there are many fields as a central bank where we can be active. And I will focus on macroprudential policy, but also some supervisory issues will be touched regarding this, and also in the monetary policy side, we had green program which was supporting green housing in Hungary. So there is a big theoretical debate whether there is a good economical reason to support the greening the economy, and debate is on whether green and sustainable products are truly decreasing PDs or LTVs or not. So essentially this is the question, and for sure it depends on the product itself. But for example, for mortgages, what we have talked about, or the colleagues have talked about, is what we have seen with the gas prices. So, for example, in Hungary, we modeled the change of housing prices in 2022 during the energy crisis, and what we have seen is that those houses which were relied more on gas, their prices decreased, and the good energy efficient houses without using gas, the prices of these homes increased a little bit. So there was a huge divergence between the two. So this underlines that we can differentiate between LTVs. And also, for example, in utility cost, in gas cost, in many cases in Hungary during 2022, in households, 8th or 7th, 8th time bigger gas bills were coming, which shows that the PDs can be changed abruptly and significantly after this type of shocks. So I think, although it is hard to prove for a broad set of products, but in certain products it is easy to see that there is a room for green premium, which actually is not applied by most of the banks. And the big question is how we can measure it, and this is, I think, the biggest reason why we don't have more brave steps in that area. That we are we are still in the early phase of measuring, understanding what is happening, which type of business has which type of effect on the environment. So measurement is a big question, and globally there is big divergence between countries which type of data is available and which not. We in the Central Bank of Hungary, we have a dedicated green portfolio in our FX reserve as well. And for example, for those companies which are big companies, for sure, it's still hard to evaluate their true ESG scores, their true Scope 1, Scope 2, Scope 3 measures. So it is a big question for the future, and this big question will be essential for future regulatory steps. But until then, there are some rooms to move. For example, we have a so-called certified consumer-friendly housing loan, which is a popular product. It helps customers to be able to compare different banks' mortgages, and we green this product, which as it is a popular product, which helps to have more green products in the market. As it was said before, among the capital buffers, mostly the systemic risk buffer is what is applicable for environmental issues, and we have experience not in environmental issues regarding the systemic risk buffer, but we used it for non-performing loans, non-performing commercial real estate loans, and it worked very well. So we think that it can be a very efficient type of regulation to somewhat change the directions of lending of the banking sector. Although here it is also a big question how to evaluate. There are some type of ratings, especially for commercial real estate, but those ratings are still under construction. So 10 years ago, BREEAM and LEED was something we thought that it is it's solving all the problems of the world, but now we see the disadvantages of these ratings as well. And what we have actually done on the sustainability, that we have a mortgage bond funding adequacy ratio to diversify the banking sector's mortgage financing, and there is a preferential rate for green mortgage bonds in this ratio. It underlines the factor that you can support greening on a positive way as well, which is very important, I think. So when we talk about stick and carrots, there are many opportunities to use carrots. This is one way, for example, but also it's another way, and it's more like a supervisory tool that we have green preferential capital treatment as well. So for green type of lending, banks can have a preferential capital requirement, lower one, which at the end makes it a little bit cheaper to lend for these green type of projects. So these are from my side. Thanks.
Thank you so much, Adam, also for pointing some of the practical issues. Now we have Sylvia. Sylvia, nice to see you, if only online.
Hello. Hi.
Go ahead,
Hi,
please.
everyone. Sorry for not being there physically, and thank you very much for the invite. Shall I share my presentation, or will it be shared?
I believe so, yes. Yes, if you can share yourself, that would be, I think, the best.
Okay, let me see if... Can you see my screen?
Yes. You may want to just go into... exactly. Perfect.
Is it good now?
Sylvia, thank you. Yeah.
Okay,
yeah.
Thank you. All right. Thanks again. And as Jeremy was saying, I'm Sylvia Merler. I'm a non-resident fellow at Bruegel, but I also work at a global asset management firm where I'm in charge of actually the sustainable investment framework across a variety of investment products. And some of those investment products are focused on banks. So over the past 3 years, I've been doing a lot of work on trying to understand how to measure both risks for banks, climate-related risks for banks, and also the other way around. So obviously, banks' own impact on the environment. And so I thought I would bring a few data from this work to this conversation to sort of give an idea of how far along or not far along we are in both having the kind of data that my fellow panelists were very rightly arguing are essential for then being able to use as the basis for policy, but also where we are, at what stage we are in this very important transition. So it's been very clear, I would say, to me when doing this work, when starting to do this work, that banks are a key sector to look at when we think about climate change and climate-related considerations, because banks are the gatekeeper to the transition due to the key role they have in allocating funding across the economy. But we do not know much, or we're only starting to know something about what is the real exposures of banks to climate-related risks, because up until recently, there was no regulatory requirement for banks to really disclose exposures to sensitive sectors and or generally break down the green or brown, let's say, character of their loan books. So over the past 2 years, we've been working a lot on putting together some data on this, and it was very difficult to find. If you take, for example, one of the main sources for this kind of data, which is the Carbon Disclosure Project Climate Change Questionnaire, which is a questionnaire that corporate and financial issuers can voluntarily submit their responses to, and it's probably the leading sources in terms of emission data that is not of a regulatory nature. Only about 25% of the banks that are filling out the CDP climate change questionnaires report the most important category of emissions when it comes to the banking system, which is their financed emissions. Because, of course, both banks' impact on the environment and climate change impacts on banks comes in this particular category, which is scope 3, 15, category 15 emissions, so what they finance. For those banks that do disclose, unsurprisingly, we see that finance emissions dwarf operational emissions. So this is really the area where we should have more clarity and focus when we want to assess also and map out risks when it comes to climate change related events. But over time, this has not improved that much. So if we look at the carbon footprint of banks, and this is also one of the results in the excellent ESRB report, I highly recommend it to anyone who's interested in this topic, because it's really excellent and has a lot of very interesting findings and charts, and also the policy recommendations are very good, I think. But one of the findings is that we didn't see that much improvement in banks' carbon footprint. So the risk is still very much there and very much present. So I thought I would show you just some data on how far along we are or are not in terms of banks transitioning towards a net zero compatible, let's say, business model. So there's been this work, first of all, disclaimer, this work is done on a sample of about 130 banks, representing around $6 trillion in market cap. It is basically the constituents of the iShare Global Financials Index plus a few more. 41 of these are EU banks for about $1 trillion in market cap. So it's a very big and representative sample. Signing up to net zero initiatives, it's been very popular over the past, let's say, couple of years. Membership is extremely high in Europe, and 95% of market cap of those EU banks that I mentioned are signatories to net zero initiatives. But when it comes to actually implementing policies to reduce the risk in the loan book, particularly exclusion policies around financing some very high risk, as we know, very high risk brown types of fossil fuel energy, such as coal or Arctic oil or oil sands, the record is less stellar. So coal policies are very widespread by now, at least in Europe. You can see that it is not so much the case in the non-EU part of the sample. So Europe's clearly ahead in terms of transitioning its banking sector towards a more sustainable business model, but still in the 80% range. So there's room for improvement when it comes to other, let's say, non-conventional fossil fuel production methods, Arctic oil sands, for example. The take-up, the translation of commitments to policies is less evident. Net zero targets also very popular over the past 2 years. A lot of banks state that they do have set or are committed to set a science-based emission reduction target. As much as 90% in the market cap of my EU banks in this example would say so, but only 44% of actual formal commitments that have been approved by the Science-Based Target Initiatives, and only 2% have validated, which means approved and in place science-based target. Why is this important? Because for banks in particular, and for financial institutions in particular, when setting a science-based target, they are expected to also set a target for Scope 3 Category 15 emissions. So for that part of their footprint, which is the most relevant and the one that it's more difficult to map and to transition. So the fact that we do see these relatively low numbers, still much higher than in the rest of the world, but it shows that this transition is taking time. So it's a relatively slow, as probably expected, process. When it comes to lending, as I was saying, it's very difficult to find the data on green versus brown in banks' loan book. I mean, I'm sure from a central bank perspective, it's different, but like for outsiders, we now do have the Pillar 3 disclosures about exposures to fossil fuels, for example, or highly polluting sectors. But a broader understanding of the sustainability of the loan book, I think, is still relatively missing. There are some initiatives going in the direction of collecting this data. I'm presenting here cross-country picture from using Bloomberg data on this topic. And what comes out is, once again, Europe is ahead in terms of shifting the loan book towards greener, let's say, activities. The ratio of lending to low carbon energy supply as opposed to fossil fuel supply, for example, in Europe is about 1, so it's 153%, and growing, but still far from what research shows it should achieve, which is in the order of 400%. So once again, we're going in a good direction. We're starting to have more data, starting to map out things a lot better, but the process seems to be slow, and still I think there are informational gaps that are extremely relevant, especially when we think about then implementing a policy. So last, and then I'll close because I think I'm already over my time. So I think ultimately, and the speakers who talked before me, I think, made an excellent job at highlighting this when it comes to what the central bank role is in terms of fighting climate change or promoting sustainability. There are trade-offs and there are questions that we need to ask ourselves and answer. And I think one of those trade-offs is the fact that managing climate-related risks is not necessarily the same as reducing emissions, even though I believe a lot of people might think this is the same. It may be the same over the long time horizon, but it is not necessarily the same over all time horizons. And I think in a risk management perspective, it can be optimal for prudential authorities to increase capital requirement on loans that are likely to bear high climate risk, even if this were to result in lower green lending. So it's a trade-off, and it's I think it's an important question to say how far are you willing to go in sort of like disregard to some extent prudential considerations for the purpose of instead achieving a real economy outcome. At the same time, and related, and I think this is something that also came out from previous presentation, is green is not necessarily risk-free. We talked about mortgages, but if you were to think about lending to corporates, and if you think about what happened with a lot of renewable energy player this year with impairments, green lending is not necessarily risk-free. So once again, in an incentive shifting perspective, it could be optimal to tilt capital requirements to promote more green lending or penalize brown lending. But then there's a question of what is the actual then prudential impact of that, and where do we draw the line? And then I think most important when we think in systemic terms, macro is not always just a sum of different micros. And this is especially true, I believe, in the context of climate-related systemic risks, because they're likely to be non-linear when they materialize. So I do think there is a very strong rationale for thinking about macroprudential overlays against climate-related risks, but it will be essential to really understand also the interaction at the micro level, as some of the previous speakers rightly pointed out, because the risk is that you may end up creating an unlevel playing field if you don't do that. And of course, to do that, data availability is key. So I also agree with what was said earlier, that this is really an important, essential, I would say, element to then be able to actually discuss policies in more detail. And I think I ran way over time, but that's the end of my presentation. I'm happy to delve into any of this further if needed.
Super. Thank you very much all for speakers. So we're gonna have 2 rounds of questions up here, and then one that involves the floor and the online audience. And it's both going to be about essentially beefing up the case for green macroprudential policy and asking how we can worry about some of the unintended consequences and the trade-offs of the type that Silvia had on her final slide. So you have, to some extent, already spoken to this question, but I think it's worth bringing it out. So the way I would put it is, if we have existing macroprudential tools, like a debt service to income ratio, and then the measures that we focus on in these tools change their meaning, or have a different informational content with respect to the thing that they were designed to do, namely, for example, to make sure that mortgage service is not too high relative to what the borrower can afford, then there is a trivially easy argument to make an adjustment, right? That is essentially why Christina is on such safe grounds with her tools, right? So simply an income to a debt service ratio is going to mean something different if someone moves into an apartment that consumes a very substantial portion of income in terms of energy costs than if it does not. So it is very easy to see why you should make such an adjustment. Now, outside that context, it might be a bit more difficult to see. And so the argument that is not altogether clear is whether, with respect to new borrower-based measures or with respect to capital measures, regulation can do better than what the banks are trying to do themselves, right? So banks have obviously incentives to be careful about their borrowing. We also know that they have insufficient incentives to do that from the perspective of the public sector, because otherwise we wouldn't have financial crises that are very costly. But the question is why the generic mechanisms that are there to fill that gap between the caution that we want to instill on the side of the public sector and what banks themselves will do, why that buffer needs to be modified just because a new set of risks come up, right? So, for example, the fact that some firms may go out of business as a result of climate change is no different from a perspective of the bank to the risk that, for example, a firm may go out of business as a result of globalization or something like that. Yet we don't have, globalization adjusters to capital ratios. So if you can maybe justify why in this specific context we need these types of adjustments more than in others, and generally why leaving the private sector to itself is not good enough. So that's essentially my first set of questions. And by the way, you don't all have to answer, but those that would like to certainly are welcome to.
Well, I can start on this question because I think it's an important one, and I think 2 issues should be clarified. First, climate risk is another type of systemic risk. This is nothing fundamentally new. We had systemic risks in the past. They often come from real estate, as we know. So that can be residential or it can be commercial real estate. And these sort of systemic risks, they tend to be underestimated by the banks. and by lenders. This is also, we have a lot of evidence on this. So this is why the basic rationale for macroprudential policy for this new systemic risk is still in place. Now, it gets a little bit more difficult when you come to the two sub aspects of macroprudential policy. So strengthening the resilience of the bank, I think that part is almost beyond dispute by now, as we will have negative implications of transition risks and further down the road also physical risks, flooding, drought, whatever you have. No? So that part is difficult to quantify. I absolutely take you this. There's a lot of work going into this in terms of stress testing and other scenario development. It's getting better and better, but it's certainly not perfect yet. But this part is clear, I think. The second part about reducing the buildup of the risk, that is a little bit more difficult when it comes to green macroprudential policy, because ultimately that means you want to influence the banks to reduce lending to high emitting sectors. This is really what this is about. And there is, of course, partly a financial stability argument behind that, because it is a risk and it will have financial consequences. But say the clarity is a little less than on the first part, I would say. At least this is my personal opinion on this. Yeah, I would leave it here.
Anyone else? Yes, please.
Yes, maybe I would like to talk about this, what you outlined is regarding should we leave the industry alone to deal with these kind of aspects, and what we saw in Latvia that, of course, this demand for cheaper housing, if it wasn't large enough before, then when the interest rates started to rise and for new housing, the prices rise continuously from year to year, people started to grow this demand for these kind of houses. And that is not what we, of course, want. Not only as a policymaker, but also from this financial stability, sustainability aspects. We do not want people to run for the cheaper thing, even if because the consumer does not have a perfect knowledge. He cannot see everything and cannot account for every risk. A typical person will buy the best thing that they want for the cheaper price. That's, I guess, normal rationalization. So therefore, we tried to, I would not say give a carrot, or we tried to do a positive stimulus on this. Therefore, we saw that the loosening of our BBMs on this kind of stimulus could be somewhat beneficial. Yes.
Adam?
So let me divide into two. So first, if we want to change the whole structure of lending, for sure, this is not only a matter of risk, but a broader view on how the economy should work, and then we step in not just because of a risk point of view, but for more systemic, in economic level, systemic issues, and I think. It is really out of the scope of a bank optimization. But on the other hand, from risk point of view, the optimization for the bank is maximum 3 years, but I'm afraid it's lower because, a CEO of a bank usually can see the next year in its current position. So there is a big difference in the thinking of a banker than thinking of a policymaker. And let me give just 3 very brief examples. The first is the Swiss franc lending for Hungary and for Poland, and Romania was the same. So it was pretty clear that it is a risk. In the central bank, we advocated it 2 years before the global financial crisis that it is a risk, but we didn't really have the tool to avoid it. But it's pretty similar to when we think about adjustable interest rate mortgages, which is in Hungary we could it avoid because of our macroprudential policy to have a huge chunk of this type of loans. But for example, in Poland, it is still a big problem. And the third one is what I mentioned, is the experience from the energy crisis, which is that there can be very abrupt change in in the prices, in the value of real estates due to changes, for example, in energy prices. And we are in a lucky position in the sense that TTF got back to 35 or something from this 300. But if it stays there, I don't know what would have been done by different states in Europe, because for a short period it was easy to give the subsidies, but for a longer horizon, none of the budget could do that.
Silvia, do you want to add anything?
No, I 100% agree with what Adam just said. I think the rationale for public policy as opposed to leaving it to private actors is exactly in the difference of relevant time horizons for the two. Just to give one extra example, I mean, for the data that I showed, there's one data that I didn't show, which is a very vast majority of banks are subscribers to the recommendations of the task force on climate-related financial disclosures, where they are requested to identify climate-related risks and opportunities within their business. But then when we look at, again, the actual implementation of policies to actually reduce those risks or foster those opportunities, we do see a gap in implementation, which is much slower in practice than taking the commitment. So I think that gap is where public action can really add value.
Right. So in some sense, the data you showed actually speaks directly to the question. Okay. So, but my second issue has to do with whether green macro-pru could do more harm than good, and how we address that risks. And so I have sort of two sub questions, and you can take either or none or both. So one has to do with the design of our tools or the choice of our tools. So what Rainer particularly was very upfront about, but also Adam, is that we have many information problems, right? There's first of all a lot of uncertainty about how physical and transition risk itself will pan out. We'll realize there's a lot of uncertainty about exposure to this risk because we have limited information about what banks, who they're lending to, and about the activities of the borrowers. And then, of course, there's uncertainty about how, even if we knew all these things, how they will impact the financial system. And so that would argue that we should pick tools that are, in some sense, robust to this lack of knowledge and have small unintended consequences, right? And you made this point, Rainer, to argue for gradual introduction. But beyond just gradualism, does this also have implication for the choice of tools itself? So we would need tools that sort of have low cost if we are wrong in our prediction, and that cover a whole range of risks, regardless of how they pan out. And then the second is an argument that sort of was, I think, implied a little bit by what Silvia had on one of her slides, which is, I mean, Silvia made the point that green is not necessarily safe, but green may also not necessarily be green in the sense that we may need, there's a well-known argument that perhaps we need hard to abate or brown activities for the very purpose because they are necessary during the green transition. And so if we penalize lending to those sectors, so hard to abate sectors that are important, for example, to building a green infrastructure or accelerating the green transition in other sectors, construction related sectors might be an example. Are we then doing more harm than good? And is this something that we can build into our macro-pru instruments to address it? So at some level, maybe this is the reason why we need macro-pru rather than just micro-pru, right? Because we want the impact. We design them with respect to the ultimate impact on the system. And so if we are worried about the financial stability of the entire system rather than about just the loan portfolio of one bank and how that risk changes, maybe macro-pru policy is actually able to see through these things and say, well, actually a bit more brown lending for this bank might be good, so we're not actually penalizing that, to the extent that it ultimately has a green impact on the system as a whole, and as such lowers the financial risk to the system as a whole. So I can see that sort of macro-prudential policy can conceptually get this right. But in practice, it seems to me very difficult to do. I mean, it could lead to very complex tools, which sort of gets me back to the first question, when, you know, complex tools are then possibly not very robust. So I'm making a mess with my questions, I think, but you get my general gist, and so you will make sense of them. Shall we go in reverse order this time? Maybe, I don't know, Sylvia. Do you want to start? This relates to some of the things on your final slides, but feel free to pass on to Adam if you prefer.
No, I think it's an excellent question. Of course, a very difficult one. I think when it comes to the way we think about brown versus green, this is very much a reflection of also other tools that we have in the EU Sustainable Finance Framework, in particular the EU taxonomy. So the EU taxonomy is binary. There's a green versus, or actually there's an aligned versus non-aligned, which you could sort of like think about in terms of green versus non-green binary distinction. And I think that one problem with that is exactly what you were saying. So transition finance is not very well covered in that, and it's difficult to understand how it should be treated, because in like some activities that are transitional are considered as already aligned, and in the EU taxonomy they're considered to be already green, so to speak, even if they actually are not. Others are considered to be non-green, and so probably the willingness to lend to those activities, if that regulation becomes biting, will decrease over time, and this may have an undesirable actually effect at the systemic level. So I 100% agree with you. I think part of the reason why we have this difficulty in framing transitional activity has to do with that approach, with that framework. So to some extent, it is maybe out of the hands of then the central banks to deal with that, because obviously that's in other legal remit. But I think when it comes to then translating into tools, that it's an important distinction that should be made. Maybe even for a transitional period, to just not have green promoting factors and brown penalizing factors, but also to have something in between that can target those activities that are really instrumental for the green part to then develop more. But as to how to do it, I think it's a very difficult task.
Right. Adam?
So let me give just 3 comments. The first is that the usual risk of macroprudential policy is that it can choke the economy. And I think what we have to keep in mind that in many cases with greening the economy, we open new fields for the economy. So it is not only a one-way street with looser regulation for green direction. Probably you can make more reliable business plans for different green projects. So this is the first one. The second is that we, as I mentioned, we use more carrots than sticks, and the reason behind is this one, that using a carrot is riskless compared to using a stick, because for the normal business making, nothing will change, but there will be some preference for green direction. So this is probably a solution. And the third one is a rather practical one. In the last years, we started to talk very deeply with engineers, construction industry. I've been in the technology used in university many times. So we just try to find all the experts who can give us relevant suggestions.
Thank you. Let's be brief because we want time for one more. round.
Yes, maybe I will be very brief on this. I think that everyone and institutions, supervisors, central banks are encouraged to do more. Even in this imperfect system, we don't have data much on everything, but everyone's encouraged to do something as of now already, to be very precautionary nature. So, of course, while there is not clear data on some things and there is a lot of data gaps, it's still expected at certain degree that something is should be happening already right now. So I think, as Adam already mentioned, therefore it's a lot of carrots, because in general everybody is very cautious to not disturb the system as it is, but rather to give bits of stimulus and incentives to start. So kind of raising awareness and shift this policy or general view to this sustainability aspect. Yeah.
Rainer?
No, just one point. I mean, macroprudential policy is actually extremely complex, and there is such a range of different instruments that even now and before this whole discussion started, there's no agreement, for example, on an overall macroprudential stance, like monetary policy. That just doesn't exist. Mm-hmm. So against that background, I'm actually very happy that some of the existing tools will be used or are now expected to be used for this purpose rather than developing something completely new. And of course, how to calibrate it and then how to bring it into practice, that is still a lot of work. And I think we are not there yet.
Great. Questions from the floor, please. We also have already some questions online, which will appear here and are slightly hard to read, but we'll get around that. Yes, please. If you could identify yourself when you ask your question or make your comment, please.
Hello, Juraj Kotian, Erste Group Bank and also member of Slovak Fiscal Council. I have a question regarding adverse effect of these increased macroprudential policies, especially regulatory arbitrage between lending to the private sector and lending to government sector. So we know that the governments are doing also a lot of brown investments. They are subsidizing energy prices for households, which are also like based on fossil fuels. And also they are providing capital to the development banks like export-import banks and others, which are also providing guarantees for companies which are, I would say, doing a brown business. So how do you see the relevance also to control the government sector and maybe introducing non-zero risk weight for lending to governments, which would make sense, and increase the space also for incentivizing into investments into government bonds, which should have a much lower capital weight. So how do you see this need to differentiate between lending to government and the normal one, standard, which is unconstrained, and let's say green, which should be incentivized?
Excellent point. Do we have anyone else from the audience? Otherwise, I will go to Slido. So there are, you can see there are the two questions essentially on commonalities and differences between the three countries that we have on this table, and also a country on sort of the question on the rough magnitude of green lending. So if anyone wants to take that would be good. And then on the last point, can the head start of EU banks in setting net zero targets be seen as a competitive edge for the EU banking system? Can EU banks set the standard now that others will have to adopt later? I don't know if Sylvia wants to speak about this possibly, or anyone else. And then we have a question about I don't actually completely understand it, with talking about climate risk mitigation. What about risk with energy transition, with phasing out conventional power sources and relying on renewable gas? I'm not completely sure how to interpret that. Rainer, do you know how to interpret that?
I don't know. I have a guess.
What's your guess?
I think the guess is that we are moving away from the traditional mix, which is more coal-based, gas-based, nuclear-based, to renewables and gas. And of course, this is, for example, in Germany, is a very big discussion at the moment because nuclear was stopped, as you know. And then the renewables is great, but of course, in terms of the security of the service, that can be an issue.
Right. So it goes a little bit into the direction of Sylvia's points. Okay, so we go back to the panel. We have tried from the beginning in one direction, in the other direction. So let's start with the middle in this case. Christina, you go first.
I'm not sure which particular question.
You can pass. Anyone.
Maybe
you can pick and choose.
Maybe I can account for this public and private lending aspect because why we are focusing so much on this private because the public has certain rules and expectations. So in a way, we are already expecting that the governments are doing something regarding sustainability. Of course, I'm not very familiar with all the peculiarities in every country, of course, but in a way, governments are expected to start to implement sustainability and sustainable considerations in their own activities. And as a primary sustainability frontrunners, for to say, should be the governments, should be something that they do. And these private people, households, non-financial corporations are usually the ones who follow after, on whom should have, I would not say maybe impose a macroprudential policy toolkit, but they will be the targeted ones because the government should be in a way covered already in some way. And maybe from these questions, I like the question about green loan, but then there's a question, what is a green loan? I think I like the debate on this also from the research papers. But for example, regarding our borrower-based measures, when we try to focus on the lending, what we want to be as a targeted scope that should be lended, then there was this loans for the houses that have this quality certification level. So, and we already saw that it is quite low. And if I remember correctly from the international research, then regarding green loan, what is a truly green? Then it's I think it wasn't that high, this share overall in Europe. So yeah.
Maybe before I pass on, let me rephrase the question on government. So, sure, one can say that you guys, the regulators and the central banks, you provide discipline for the banking system, and then voters provide discipline for the government. So it's not your job to discipline governments. However, it is your job to protect financial stability. And to the extent that the risk of sovereign bonds is affected by the climate change and is differentially affected, there could be an argument to think about risk weights more than in the past. Now, it would be extremely controversial, right? It's never going to happen, probably. But as a conceptual argument, I think it's a pretty nice argument. There's some evidence in your report on sovereign risk. No, I shouldn't say your report. And in the ECB report on sovereign risk, essentially showing that the climate change will have some impact on debt-related risks in the euro area, and also that this is quite different across countries. So it's not a completely absurd idea. And the question is, I mean, my instinctive answer is that it is still perhaps a second-order issue compared to exposures to other borrowers. And the fundamental reason for that is that countries are more diversified than individual entities, right? And so it is hard to think about transition risk as being quite as impactful on a country level than at a national level, but this may be the wrong answer. So anyone else who wants to chip in on that question from that angle? Please, Adam.
So, two practical answer and one more like theoretical. So I think what what is important is that there was a debate about raising the risk weight of government bonds because of the huge exposure towards governments, and it failed. So politically, it cannot really happen. And the other part of the story is that we have to save financial stability, and if we change the risk weight of government bonds, it will reprice the government bond stock. It will have huge impact on the markets, which probably in itself start some turbulences on the market, and we don't know the size. From theoretical point of view, I think what is important that the government, the working of the government bond market is among those fields which really have a huge control by the market, and for this reason, many of the countries started to issue green bonds more and more because they see that they can reach new markets. So I think the market can drive this process, although for sure it is very hard to turn to only green issuances, for example, because you have to pay the different subsidies. You have to pay for the unemployed people, etc. So there are a lot of stuffs in the budget, but you have to pay at the end of the day anyway, and it is not really related to the green and non-green topic. And just a quick answer for the first question, because nobody answered, and I have some data on my mind. So since we have this green capital requirement, the favorable capital requirement for green loans, we know that this portion is about 5 to 10%, although the requirement is very tough for the banking sector, very strict, and we start to expand it. So what we call green loan today, it is this size, but later it will be a bigger proportion. And green type of mortgage loans, so about 15 to 20% of the housing stock is at least not energy inefficient. So in the energy efficiency certificate terms, C or better, it's about 15 to 20%. For sure, new mortgages new mortgages prefers a little bit newly built houses. So I'm sure that the ratio in new mortgages, it is a little bit higher, but something like that.
Thank you, Adam. Silvia, anything to add to any of these points?
I think I wanted to add something on this conceptual idea of the climate-related sovereign risk weights that I think is super interesting from a conceptual standpoint, but I think you risk having a lot of unintended negative side effects. So just to make two examples, if you take a physical risk perspective, a lot of the countries that would be highly exposed to physical risks are emerging markets. So you would likely be making it more expensive for those countries to raise finance, also for the purpose of adaptation to climate-related risks, unless there are some tweaks around adaptation finance. And if you take a transition risk perspective, the United States withdrew from the Paris Agreement between 2017 and 2021. Would you be putting higher risk weights on US Treasuries because the government is quite clearly taking a political stance that goes completely against any transition objectives? I doubt it. So I think it's a very interesting idea conceptually, but when it comes into putting it in practice, it becomes impossible to do so. And maybe I'm just going to take the last question, which is the one on banks. I think if you had asked me this question 1.5 years ago, I would have said yes, definitely. It will be an competitive edge, and everybody will have to follow because the direction of travel is really, really clear. I am a bit less sure now because if you see what's going on, for example, in the US with the backlash against sustainability policies when it comes to lending and investing, I am a little bit less sure. Things about, for example, the state of Texas blacklisting some US banks on precisely because of their ESG or sustainability factors and policies in lending. So I think there is not that level playing field and agreement at the global level at this particular time. I still think the direction of travel in Europe is the one that we should be following based on science. But when it comes to specifically it being a competitive edge, I think the picture is a little bit less clear today than it was, say, 2 years ago.
So I'm going to give Rainer the last word, but before I do, I want to answer Jura's question myself. So I think there's one instrument that would not have the problems that were correctly pointed out by Adam and Sylvia, which is you could, I think what would make a lot of sense is for sovereigns to issue sustainability-linked bonds that are conditional on adaptation measures rather than necessarily on their own emissions, right? So if you have sovereigns that are substantially exposed to these risks, then by issuing such bonds, they might be able to get more favorable financing conditions, because to the extent that the measures that they propose to link the bonds to materially improve their solvency. And that might be a way of helping to commit to actually undertaking those measures, which may, in a sense, complement whatever discipline comes from voters. So there's, of course, then an interesting question, why don't governments do that? I would say the answer is that in certainly for the bigger issuers, it's not enough of a risk, and so the material impact would not be big enough. But if you're talking about a Caribbean island, probably we are in that territory, but that's not the Eurozone or even the EU. So Rainer, please.
Thank you. Now, just two small comments on the first two questions. So on the green loans, I don't have an estimate of the overall stock of green loans, but there was some measurement on the take-up of this easing of the DSTI requirements that I was referring to in my early intervention. So when this was devised, the idea was it would increase lending by around 5 to 10% in this category. Turned out to be lower than that. So the latest estimates are more around 3. But of course, this should be seen also conditional on the overall situation in the housing market. So there was some positive effect. How much it was exactly, that's to be seen. And then I think on the second question, well, the differences and similarities in Latvia, Slovakia, Hungary, I would expect there's a lot of similarities because all three countries are sort of post-transition economies with a relatively large old housing stock. So I think what Christina mentioned, for example, to Latvia, I think this is something that would also apply here. Thank you.
Great. So I've been a terrible chair. We are 8 minutes over our allocated time limit. I really thank the panel. I thank you. There were great questions both in the audience and online. And, you know, I think the takeaway is this is really important. It probably needs to happen, and it's complicated. But I hope that the panel helped you think through some of the complications as well as making you aware of them. So thank you again. Bye-bye.